I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Pick and choose your own best-of-breed insurtech and data providers with Advantage Go's ecosystem. Today's guests work at a Lloyd's members agent. Their job is to give advice to names, the high net worth individuals providing underwriting capital to Lloyd's syndicates. Their clients provide just under £1 billion of capacity to the market. There was a time, around 20 years ago, when such a role might have been seen as perhaps a little quaint, one of those odd quirks that the Lloyd's market seems to specialise in. Back then, the brave new Lloyd's was focused almost exclusively on corporate capital provision, and private capital seemed to be condemned to a managed long-term relative decline. A lot has changed since then. These days, Director and Head of Syndicate Analysis Emily Apple and Andreas Wichmann, Business Development Director at Alpha Insurance Analysts, are busy assessing a strong pipeline of both continuing and new business opportunities in the market, as entrepreneurs rediscover the attraction of engaging a loyal and dedicated source of meaningful underwriting funds as part of their capital mix. New forms of tenure for names are also helping make them a more attractive source of capital to managing agents, while investors seem finally to be gaining more awareness of the many capital and fiscal advantages of underwriting as a private individual. Emily and Andreas are hugely experienced, highly knowledgeable and great company. They have an excellent overview of the Lloyd's market and its prospects for ventures new and old, and this podcast paints a detailed picture of the opportunities in the market from an investor's perspective. You'll learn a lot, and if you've ever wondered what it takes to become a name and how the whole process works, this episode will give you all the information you need. Enjoy the podcast. Andreas and Emily, welcome to the Voice of Insurance.
Thank you for having us.
Why don't you tell us a bit about your careers today for anyone who's listening who doesn't know you very well? Emily, why don't you start?
Yes, thank you very much. My name is Emily Apple. I joined the market 26 years ago, so quite a while ago. I read mathematics at Oxford and then fell into the insurance market, really. I knew nothing about the workings of the Lloyd's market at all, but I joined Christie Brockbank Shipton Members Agency. And at the time, there were about 8 members agents looking after clients. And it quickly consolidated down to about 2 by 2006.
The consolidating down to 2 was what made Alpha Insurance Analysts be formed, isn't it, effectively?
Exactly.
Or that's when it started?
Exactly. We formed for 2007. We wanted to give private members a greater choice and a members agent that was analysts-driven but didn't charge profit commission. So those were our 2 sort of main identifying factors of the members agent Alpha that was formed.
So in terms of, the profit commission, the other members agents, yes, are an extra profit commission, aren't they, for the names, the capital provider?
Exactly, and we believe our members take all the risk and therefore should get all of the reward.
So yours is a flat fee type thing?
It's not a flat fee, but it's a fee based on underwriting level, but all of the profits that the members earn each year.
So more like a percentage?
Yeah, a fee plus a percentage, yeah.
Okay. Andreas, what about you?
I have a very different background. I studied economics in Munich, came straight to London and had 20-something years in wealth management. First with Donaldson, Lofgren & Jenrette, which was bought by Credit Suisse First Boston. Did that for almost 10 years. And then I started the investment advisory business at Deutsche Bank, wealth management here in London. Went to a family office and after 3 years there, joined Alpha.
So had you had much of interaction when you were with those family offices? And is that how you found out about it? Or you just sort of applied for a job in the newspaper type thing?
Very, very little exposure. We did look at ILS, both at the wealth management side and at the family office. But probably being quite ignorant, like a lot of other banking city members, where you see the Lloyd's building, but you have actually no real idea that private capital can play a role there. So it came a little bit out of the blue, but I had some lovely conversations with Emily and Emma and the rest of the team, and it sounded like a good opportunity.
So we already started this question about Alpha Insurance Analysts. You're a members agent. Just remind anybody who's listening what that is.
So we look after private individuals who commit their personal assets to underwriting in the Lloyd's market. And a few of our members are still on the old-fashioned unlimited liability basis, but the majority of members these days commit capital on a limited liability basis, either through a limited company or a limited liability partnership. And they provide capital to a spread portfolio of syndicates within the market. There's about 100 syndicates in the market, and not all of them are available yet to third-party capital, but our members can access around 40 they can choose from.
Yeah, I suppose if you describe it to someone else, would you say you're almost like an investment advisor, but Lloyd's requires a member's
Absolutely.
agent.
Yeah, Lloyd's does require a member's agent. You can't access a spread portfolio of syndicates without a member's agent.
You can't just turn up. The sort of widows and orphans and the sort of unqualified people can't just turn up and say, right, I've got £10. Can I put that into Lloyd's?
We have plenty of widows and orphans, but no, they can't just rock up without a member's agent.
So your job is to look at the Lloyd's market and look at those 40 syndicates that are available for those names, for those private individuals to provide capital to. Where are you happiest at the moment in terms of advising those names to put their money?
So we look at all different opportunities in terms of the classes of business that syndicates will underwrite. So some of the syndicates that we support underwrite across a broad spread of classes, composite syndicates. Other syndicates that we support are what we call monolined, might just be focused on one area, like, for example, nuclear or perhaps US catastrophe business. And we build a portfolio based across a broad spread of syndicates, which themselves are potentially underwriting across a broad spread. So there's risk management at various different levels. We generally probably prefer the shorter tail classes rather than the longer tail classes, because that's where you can take corrective action quite quickly if something's not quite performing as expected, and you can see that corrective action might be needed, and you can also see the profits come through quite quickly, whereas the longer tail classes have had some sort of problems, you could say, particularly on the reserving side. And that's where some issues have come through, some latent issues. And so we err on the side of caution always for our members. But generally, that doesn't mean we don't have the casualty classes within our portfolio, but we probably prefer the shorter tail classes.
But you can get a decent spread, can't you? You can get a really representative spread of the risk that the Lloyd's market as a whole is taking with the opportunities that are available to you.
Yes, absolutely. Absolutely. You don't necessarily always want a representative spread of exactly what's in the market, because you might want to skew your members' portfolios more towards catastrophe business if that's where the rating is very strong, and less perhaps into cyber if that's where the rating pressure is coming through. And our members invest on an annual basis, so they commit capital to each syndicate for a year, and then we reassess for the following year whether that capital should stay where it is or perhaps slightly be redeployed elsewhere across the market. But generally, our members' portfolio remain pretty similar with some tweaking around the edges each year.
So you're definitely an active manager, effectively, or you're an active advisor for them, aren't you? You're
Absolutely.
not sort of passive in
Absolutely.
any sense.
I mean, we are analysts at heart. We spend a lot of time crunching through the numbers that are provided to us from the syndicates. We are checking that our syndicates are performing in line with what we would expect them to do in terms of the risks that they are running and the losses that they are experiencing according to what's happening in the market. And sometimes from one year to the next, our advice to our members is just to stick and hold with the syndicates that they are supporting, which themselves are doing some risk management. They are choosing whether to grow or whether to contract. And sometimes the advice is, especially in the softer market conditions where we're not looking for particularly new and exciting things, we're wanting to stick to our knitting, if you like, and our syndicates are doing that on our behalf too. And then there's other times in the cycle where we're possibly a little bit more opportunistic, more open to new ideas, and then we'll recommend to our members that they take on new syndicate opportunities or broaden their exposure to one or another class of business.
And so where do you think we are now? Obviously, we're coming off some really great results, and anecdotally out in the marketplace with the public companies that we're seeing reporting, they're reporting a little drop off in rates, but obviously they're still very happy with the overall adequacy they're getting.
Exactly. So we've had two very strong years for Lloyd's. 2023, which really was an exceptional year in terms of Lloyd's on an annual basis, made a record profit of over £10 billion. 2024 was another very strong year. I'm sure I don't need to educate your audience on how strong the market has been. But yes, there has been a slight dropping off of rate in the early part of 2025. The focus needs to be on rate adequacy rather than rate change, because you can have very positive rate change, but it might not be enough in certain classes of business, for example, aviation. But in other areas, you can have a very strong margin above what syndicates would call technical pricing, and therefore a small rate reduction is not the end of the world, and our syndicates are still growing into those areas even with slight rate reduction. And that's a good strategy in a strong market, because we are still, I don't think anybody would say in most classes of business, we're still in a very strong market.
With insurance, if it was very profitable, you could drop the price and sell more and actually make more profit by doing more.
Exactly. And I think that's what many of the syndicates within Lloyd's are aiming for 2025. Whether they'll achieve all of that growth remains to be seen. But yes, that's absolutely the plan.
Your investors have made a lot of money over the years and made decent positive returns pretty much every year. What sort of returns are you penciling in for them? Obviously, natural catastrophes and other disasters notwithstanding, what sort of returns are they penciling in? And obviously, with a certain amount of these things, some of these things are fairly baked in already.
Yes. So whilst Lloyd's reports on an annualised basis, private members still actually receive profits on a 3-year accounted basis. So we've just closed the 2022 year of account, which for average members at Alpha was a 12.5% return on capacity across a spread portfolio. And most of our members provide capital with a ratio of about 50%. So their return on capital, therefore, is a 25% return, which is fantastic. 2023 is promising a return of up to about 40% return on capital. And 2024, it's still early in the development on a 3-year accounted basis, but 2024, notwithstanding the hurricanes that we saw in the latter part of last year, and actually the LA fires that happened in the early part of this year, which for some of our syndicates will actually fall back on the 24-year of account.
Yeah, of course, because of the 12-month policy written during 2024.
Exactly. So, but 2024 still promises a very attractive return on capital, possibly up at the sort of 20-25% return on capital. So that's what I would say has happened thus far, even if they're yet to be paid out. 2025, as we said, is still rate adequate, and our syndicates are expecting to produce decent returns on capacity of possibly 20-30% on capital.
What sort of returns do the names also get? Obviously, get some income from the funds that they've posted at Lloyd's, don't they? So they can get a little bit more. Obviously, if they're posting only half of the underwriting capital, do you get any returns on that?
Yes. So we always talk about the W's of assets because it's one of the few investments where you can put up other capital to support this business. So our members tend to have equity bond portfolio with an investment manager, which does the returns that...
And so they can pledge that?
They can pledge it, exactly.
And that's acceptable collateral, and then...
There are a few limitations, but your basic equities, your basic bonds, your basic mutual funds, your basic ETFs...
If the stock market crashes, you might have to post a bit of extra collateral.
Exactly. There's a certain level that you have to provide, and like any kind of collateral, same in your house when you have your mortgage and your capital in there, any other investment portfolio.
So it's very efficient in that sense.
It's very efficient, and it does give you the W's of assets where you can use the existing portfolio and basically put the Lloyd's returns on top.
What's been interesting about this time, and again, you were talking before about at different times you might dabble around the edges or sit at the margins. It's been an interesting time at Lloyd's that names have been offered more opportunities than they've had in quite a long time. Lots of new syndicates coming in and getting backing from names. Are you pleased with that? I suppose it's always nice to be offered a business opportunity, isn't it?
Absolutely. And we always say with new syndicates, timing is everything. So if you're offered new syndicates at the bottom of the cycle, you need to step with caution. And it's proven to be the case that any new startup that started over the last 10 years has struggled. Very few have been profitable, especially in the early days. But no, it's a very positive move that new offerings are being offered to names, to private members. I think it really demonstrates a shift actually in perception of names capital. I think there was a time when we were seen as possibly difficult or obstructive capital, and now the shift has gone that we're now seen as more loyal, more sticky, more discerning.
Yeah, and maybe less risk averse as well. Would that be right to say?
I wouldn't want names capital to be portrayed as less risk averse. I think that it's about timing, it's about the opportunity, but I think that we are seen as an attraction where you might be seeking capital, you might have to give up some equity in your business if you were a new startup, whereas we are happy to support the proposition in its purest form for the return without expecting equity. So I think that that's a huge shift. And we can move quite quickly. So all private members are represented by, there are now 3 members agents. And if you can convince the analysts of those 3 members agents to recommend support, you can get 150 million of capital to support pretty quickly. So we can move quite quickly with the right business opportunity.
Absolutely, because obviously you're fully licensed, you're ready to go, aren't you? You've got the capital and, Lloyd's already know who you are, that you don't have to do any diligence or anything like that.
And actually our capital is already in place because our members benefit from a diversification credit across their portfolio. They have capital in place supporting all of the open years and the future years. So if you come to our members with the proposition and we as members agents think it passes muster and we recommend it to our members, their capital is in place supporting their spread portfolio. They may not even need to put additional capital in to support the extra underwriting, depending on where we are in the market.
The wonderful thing about the mathematics of diversification.
Exactly.
It's interesting. We should talk about tenure. Yes, I suppose that on pre-reconstruction and renewal syndicates, of which obviously that number, they'll all stick around because they're great blue chip stocks of the Lloyd's market. But at the same time, that tenure came about, the preemption rights. These are rights that are similar to anyone who owns equities, for example, might have. Obviously, it's not exactly the same thing, but certainly that right not to be diluted by other majority capital owners or other majority capital providers is probably the best way of describing it, isn't it? That you can't be squeezed out. You have that right, or you can't be squeezed out until you become a very small minority. And those were sort of equity style rights. And that came, as my understanding is, they came as a kind of quid pro quo because of the support that names gave to the Reconstruction and Renewal Plan of 1996. And that's why they got those rights. And then, of course, that's why they ended up expecting those rights on any new business opportunities. And well, if someone's coming with a new syndicate, they don't have to give me these rights. But they kind of expected them. And now, is it you're more sanguine about the kind of tenure that you'll be offered on a new venture?
So there's a few different parts to what you've just asked. So there's preemption rights, which is being able to grow with and not being diluted.
Yeah.
There's also the squeeze out rules, which are slightly different in terms of when the managing agent owns a certain proportion of the business.
It's usually 10%, isn't it? When you get over 90, then
the minority
you can squeeze
buyout
them out.
rule threshold. Yes, exactly that. And then there's the ability to, if you own that as a property right, you can then choose whether you want to capitalise that share of that syndicate or whether you want to sell it to somebody else who wants to capitalise it, and they're buying the potential pipeline profits and giving you a consideration for giving it up.
Yeah.
The reason generally private capital wanted that property right, as you say, quid pro quo for being there after reconstruction and renewal, and most of the syndicates within portfolios up until about sort of 6 or 7 years ago were freehold syndicates.
Yeah.
And then there was a dawn during the very strong actually market conditions of 2005, 2006. There was the introduction of limited tenancy. So you were being offered to support syndicates that you could provide capital to, but you didn't have that ongoing property right.
Yeah.
But more recently, the offerings that have come through to us and which have been attractive are being offered on this new basis called modified freehold. So it's a property right, but with some of those rights slightly, modified, clipped, if you like. So members are not being canvassed whether they will approve for a syndicate to preempt, but they are being given the preemption rights in most cases.
Yep.
There is still this rule where if a syndicate comes to 90% that they have to buy out the members, but it's on a predetermined approach rather than a more back of the fag packet sort of approach, if you like.
Yeah, and the other thing is, of course, that these rights have a monetary value as well, of course, which is ascertained once a year.
Absolutely, in the auctions that happen in the autumn. And that has been a huge part of the value creation for our members, actually. So they've had profits over the last, albeit 1 year, they've had profits at Alpha for the last 15 years. But they've also created a huge amount of value by those syndicates offering preemption rights and our members supporting the growth and each pound of capacity being tradable in the auction and having a value.
I suppose the story of the post-reconstruction and renewal Lloyds has been a long-term relative decline of the percentage of Lloyd's capital provided by private individuals. Do you think some of these changes might mean that this will go into reverse at some point?
We very much hope so. And that does feel like a trend that will continue to build. I mean, one of the reasons why private capital declined was because they were discerning, because they were withdrawing in a soft market. So we're not disappointed that we weren't squeezed out with new opportunities, but more that we withdrew because of the declining market. And now as the market has improved, we are happy to be taking a greater share. We're happy to be offered opportunities. It doesn't mean we'll support everything that comes along. In fact, we had about 15 new syndicates across our desk in the last 12 months, and we recommended support of 3 of them to our members. And our members are pretty reliant on our advice, I would say. So the majority of our members follow our advice.
Yeah.
Some do something slightly different and support syndicates that we don't recommend, and that's okay. But generally, they follow our advice quite closely. And so if we say we recommend you support this new opportunity, 80 to 90% of our members will follow our advice.
Yeah, something that's interesting also, back in the old days, pre-reconstruction renewal, it was common or even compulsory that the lead underwriter would have to be a name on that syndicate. Yeah. Is there any resurgence in working members? I mean, there's quite a lot of high net worth individuals walking around Lime Street, aren't there?
Yeah, there are. And I haven't seen a resurgence. There should be a resurgence of those people.
It would be great, wouldn't it? It would be great to see.
Absolutely, because they are knowledgeable capital and they should be putting some of their well-earned bonuses and salaries back into the market. And they may have staff vehicles that they are encouraged or offered to join, but that would be probably specific to that managing agent or that syndicate. And we can offer a broad access to a broader spread of syndicates. And we do have working members, but not enough, not as many as there should be. There was a rule that the active underwriter of every syndicate had to put their own capital behind their syndicate, and that rule was taken away from Lloyd's over 10 years ago. And we think that's a shame because it really focuses the mind. If you're an underwriter and you've made a loss on your syndicate and you have to write a check at the end of your 3-year account, it really, really focuses the mind. And some of the underwriters of some of our syndicates do have significant participation. And I think it might make the syndicate overall perform better because they're really focused on exactly what they are underwriting and how that will affect the bottom line and their purse.
When we talk about high net worth individuals, I mean, how high net worth should you be? I.e., you don't want to put all your eggs in one basket.
No, absolutely.
And therefore, what sort of percentage of someone's net worth, what's the maximum amount you would advise someone to allow to be risked in the Lloyd's market?
I think it comes down to everyone's attitude towards risk, right?
Yeah. What if they were the highest possible risk and you were saying, Andreas, and you say, look, actually hold your horses. You can't put 100% of all your net worth into
I think, look, let's go from the medium case. Let's say the medium risk kind of guy. A rough indication is 10% of your net wealth.
Yeah.
You shouldn't go really above that. But risk is a very personal kind of thing. And if you really understand the asset class, you might choose to go higher.
And what's the minimum, really, to make it viable?
I think in our route, you're looking pretty much £1.5 million.
So there needs to be sort of 10 to 15 net worth.
That kind of level, yeah.
Million.
There are other ways.
Pounds, yeah?
Pounds, yeah. There are other ways of getting exposure with different structures, but you lose some of the benefits.
We do find that some of our existing members are committing more than that to Lloyd's, but that's because they've got rolled up profits that have grown over time that they've reinvested. So a lot of our members have grown significantly from 2017 at the bottom of the cycle.
It's made them wealthy.
Exactly. And we do find often the working members do possibly commit a little bit more than 10% of their wealth because they understand the market, so they understand the ebbs and flows of the peaks and troughs of what can happen.
You look at that sort of level of wealth and you look at the stats and Gini coefficients in the world and all these things that economists look at, Andreas, you'd say, well, there's more high net worth people than there ever used to be. So total addressable market for potential high net worth people to invest in Lloyd's is mushroomed, but the volume hasn't grown with it.
I think you're spot on there. It's fairly crazy to me how underrepresented underwriting at Lloyd's especially is in asset allocations. Because when you look at it from that angle, it is a fantastic diversifier. You have very low correlation to any other asset class. You have bond-like volatility with equity-like returns, just a smidge under what you would get at the S&P. So for me, it's a lot of education, getting the word out there. And I think it's fair to say that there hasn't been a great success in that to a certain degree. I think some new efforts like London Bridge help with that. And you certainly see a bit more interest from some of the PE funds. You see some more interest from family offices. The recent Ariel Re London Bridge vehicle, which specifically aimed at the US wealth management market. That is something really applaudable. And we need to see how we make a bigger impact here on our side. And that's certainly that education element is something that we try to do a lot, going out to the investment managers, family office, etc.
So, yes, obviously you'd rather they became clients of yours individually rather than going via other forms of wealth management and going by a fund or a PE or whatever other ways of doing it. Or could you go to market and make your own funds as well and package those and market those in a way that's easier for other people to buy? Or do you think that's one of the ways forward?
It's definitely a way forward. It's not very straightforward, and it unfortunately still takes a lot of planning and lots of moving bits to come together. There were a few attempts over the last couple of years which didn't happen for multiple reasons. It's certainly something that we have an eye on, and let's see.
But you would applaud those vehicles, innovative new vehicles that have mushroomed at Lloyd's over the last 10 years, should we say?
Yes, although you need to look at the advantages of being an individual underwriting through a corporate structure, through a member's agent. The advantages can be quite a lot better than through some of these other funds, because as well as the double use of assets, which you might not always get through a fund type structure, you also get significant tax benefits.
Yes.
And you get access to a broad spread of syndicates, which, as we mentioned before about auctions, if you wanted to replicate that broad spread, it would be very expensive and perhaps quite difficult to replicate on a larger scale due to the limited liquidity of supply of these syndicates, because they're already supported by the existing private capital who don't want to give them up. So it's quite difficult to replicate exactly what we're doing here through a fund, but it is a way to access underwriting if you weren't able to do it this way.
You should be out there doing more marketing, telling everyone how great this is. And look, we should talk about tax because obviously in the UK, we've had some changes in capital gains tax rules, particularly grabbed the headlines was farms. But here we're in that sort of category, aren't we? Inheritance tax relief and other things. Are the changes going to affect names?
Yes, they are. When it comes to the impact, I think overall it's actually a net positive, which sounds weird because you're right. From April 26, underwriting at Lloyd's will not be fully exempt from IHT anymore. And by the way, we don't give any tax advice, so this is just some very broad statements. From April 26, you still get relief up to $1 million via the business property relief. Anything above $1 million then gets a reduced inheritance tax rate of 20% versus 40%. When you compare that to other changes that are going through at the same time, for example, pensions now being fully part of your estate and being taxed at the full inheritance tax rate, underwriting still is treated quite beneficial compared to that. So from conversations that we are having with some financial planners, they're actually tilting more towards underwriting at Lloyd's than they have maybe previously had.
So even though it's actually worse, it's still less worse than all the other
things.
Than
the others, correct. Yeah.
So it's not the end of the world, but also it's still tax efficient relative to everything else.
Correct.
Yes, but also our members might appreciate the tax benefits, but they are here to make underwriting profits, and they're making hay at the moment, and they're finding the investment stands up on its own merit, irrespective of the tax advantages, which are hopefully down the line.
That is the point, isn't it? Focus on the underwriting
Absolutely.
more than everything else, because things only ever tend to go wrong when people look at the tax benefits rather than look at the underwriting benefits. And obviously we can delve back into the history of Lloyd's, and certainly in the 1970s when we had marginal tax rates of 95%, certain odd things did happen, didn't they?
Yeah,
and
absolutely.
We didn't have to make an underwriting profit to make an actual profit.
No, exactly. But then we're not quite in those years. Now we're a slightly better regulated market, and therefore focus on underwriting returns rather than other things.
One of those other innovations you mentioned about London Bridge 2, which is that new capital structure, capital portal. What about syndicates and boxes? Have they been a bit of a boon to you, or are they not really ever going to move the dial?
I think it falls into the same bucket as any other new opportunities. It's a new thing. It's great to be offered new opportunities, but they need to stand up by themselves. It doesn't really matter which form they're coming in.
You're not a VC fund, are you?
No, certainly not. I mean, even though, underwriting sits very firmly for me in this alternative asset bucket, but no, we're not a VC fund.
No, exactly. I mean, you're not getting equity, are you? You're looking at what is the prospect of this making an underwriting return over this 3-year period. And if it's zero, then it better be good the year after and the year after that.
Correct. I think if you're coming from the other way around, is being syndicate in a box a red flag for us? No. If the opportunity is good,
it's just a good way of getting new ventures started. And if that's how it has to happen, it has to happen. But you're just going to look at the numbers and what that business proposition is. And in your experience, whether you think it's a good one or not. And that's what really matters, right?
Yeah, absolutely.
It's quite interesting, this world of Lloyd's changing. I spend a lot of time talking to people about the digitisation of the market, the digitisation of underwriting and broking, and that removal of a lot of the friction. It sounds like a lot of the things that you already do in terms of, I remember going back to old members agents, what were they called? Mappers. And what does the P stand for? I can't remember now. Pooling arrangements. Yeah. That was it. I remember now. Again, which is kind of like a fund of funds, effectively. So you've been doing this for much longer than anybody else in terms of providing tracker-style funds at Lloyd's. Is that something that might appeal to you? It seems like something that could make a lot of sense for a members agent to do.
So just to be clear, we at Alpha don't operate any mappers. The other agents, I think, do, but we don't. We look after all of our members on an individual basis.
Right.
They all have slightly different risk appetites. They all have slightly different circumstances. And so we don't pool our members together into mappers, these pooling arrangements. We talk a lot about opportunities standing up on their own merit and reducing friction. And I think at a syndicate level, these facilities that are coming through and digitalisation, I think it remains to be proven as to whether that really is saving anything on expenses, improving efficiency. I think a lot of the syndicates that we talk to that do have these kind of models, they bring a lot of the operation in-house more than perhaps was expected. So there's a lot of oversight of business coming through. And therefore, I don't think there's a huge amount of cost savings. Now, we think there should be a huge focus on modernisation, on efficiency, on reduction of costs. The expense ratio at Lloyd's has been stubbornly sitting at sort of above 35% and hasn't managed to come down. I think at our level, to run a mapper isn't necessarily a cost saving, because we still need to do our due process. We still need to engage with our clients. And whether any additional funds or access to pooling things together really saves and improves, I think the jury's out from our view. The work still needs to be done. The processes still need to be covered.
We're talking about reducing costs. How would we get that minimum sort of stake down, that minimum net worth? How could we get that down? Are you optimistic at some point, if we do digitise everything and expenses start to really tumble, we might be able to appeal to people who are not quite so wealthy as the 10 to 15 million bracket?
Look, there are currently other ways of doing it as well, right? For lower minimums.
I know we can all buy stocks of publicly traded
insurance
companies, some of which do trade at Lloyd's.
Yeah, I think just using that one, that is a very different proposition, right? With our underwriting, you get the pure exposure to the underwriting. if you buy either one of the listed vehicles or you invest in one of the few listed syndicates, you're buying an equity. The exposure you're getting from that is impacted by a lot of other things.
Yeah, it's the sentiment.
It's the sentiment. If Russia invades Ukraine, your share price will tank no matter what the underwriting portfolio does. So I think that's a big difference. The other vehicles that are out there are a bit of a different animal. I think for us, really to bring minimum sizes down, it's a lot of the pass-through costs that are coming from Lloyd's that it takes to actually run this as a business, because you are running a business. So there are costs involved, extra tax, etc. Digitalization will help with some of that, but that's not the whole equation. I think, again, for different levels and the hands-on approach that you can get via an underwriting as a member, which is a lot more involved in the process, there is more work involved.
Yeah, I just wanted to say, I mean, there is a huge amount of advantages of being a member at Lloyd's, and those do come with costs. You are underwriting through a trading vehicle, and that is why you get the tax benefits. That's how you get the double use of assets and everything else. And so there are quite a lot of frictional costs, but it's in order to get the benefit.
You can't just have a limited liability partnership without having to have all the filing and accounts and everything has to be done. So there's a minimum amount, that's just going to cost you. There are just frictional costs there.
There is, and we do have members who underwrite less than £1 million, for example, but then, of course, the expenses do take a large part of the potential profit, which is a shame, really, and a lot of the costs are fixed. And so the more you underwrite, of course, then your personal expense ratio would come down.
I think I've come to the end of all the questions that I wanted to ask you, but generally anything that you want to add to summarise what we've been saying? Overall, it sounds like the opportunities for names are excellent, still very, very good. You're still generally very happy and being shown more opportunities than perhaps you ever have been before. Yeah.
I think I would say that we talk a lot about new syndicates and that we are talking about them as new syndicates to Lloyd's, but actually new opportunities to us could also be existing syndicates who want to add our capital to their capital stack.
Yeah.
So we can sit alongside them, and that really suits us from an alignment of interest. It might mean that they don't want to give us freehold or modified freehold, but actually we do still support syndicates that we are alongside the aligned member if the business case makes sense.
Yeah, particularly if you've got a hard market and they're short of capital and you can partner them for those 3 really good years while the rates are spiking, and then you can come off again when they're coming off.
There's also an example where a managing agent wasn't short of capital but brought us on because they see us as discerning. They see us as possibly offering some challenge to their existing management team, and therefore they made some space for our capital to support, and it's been really one of our more profitable syndicates over the last couple of years.
That's really, really good to know. So it sounds like everything's pretty robust and things are pretty healthy. You sound like, this is a good place to be.
Yeah, our members are very happy. Their capital seems to be robust. They are reinvesting, many of them are reinvesting their profits, so they're feeling in good shape. Many of them are of an age where they are talking about bringing in the next generation. So we're doing a little bit of work on educating and encouraging that next generation to want to continue in the family business, the family Lloyd's insurance business. And then there is new capital knocking on the door and saying, I've just heard about this, and why have I not considered it sooner? It's sort of anybody who has not heard about the Lloyd's market and sees it as a proposition learns about all the advantages. Yes, it's high risk, but all of the advantages with the double use of assets and the tax. And they often look at you and think, why have I not considered this sooner? This is fantastic. Now, we always remind people that, yes, we're in very strong market conditions. And there are times when the market loses money. We thankfully have only lost money for our members in 1 year out of the last bottom of the cycle, which we're really pleased about. And that's why we suggest anybody who comes in new comes in with a modest position relative to their wealth, because they could get the timing wrong. They could come in and make a big loss in their first year. And we all know that when there's a loss in any given year, the market corrects and there are potential future profits. So you want to be able to replenish your assets and carry on and make back the losses and sums. But we're feeling quite chipper, actually, that there's quite a lot of capital interested in joining the market. They can come in and benefit from those strong market conditions. But yes, as you mentioned earlier, actually, there should be market practitioners who are not themselves involved in a spread portfolio and possibly only involved either owning shares of the company that they're in or on a staff vehicle. They should also be considering this because they can access a broader spread of business and benefit from the returns that our members are getting.
Just one last thing is that those preemption rights have been at very high prices, haven't they, in the last few years?
Absolutely. The prices have been very high. And the introduction of new tradable capacity possibly will bring the overall prices down because there'll be more avenues, more places to put your capital. But yes, prices have gone up. Our members have seen considerable value creation since the bottom of the cycle over the last 5, 6, 7, 8, 9 years. And prices have gone up quite high. So yes.
That's very valuable as well.
Yep, that doesn't mean that we would recommend our members join syndicates that are being offered for free in the first instance just because it's a cheaper way of entering the market. It's all about spread, diversification for the right reasons. But yes, it does make the new syndicates that are offered at no cost initially quite attractive.
I mean, it's also one of the reasons why most of our members will join by actually buying an existing vehicle. So they get the back years, they have a spread portfolio already in place, and then they go in the auctions and add or reduce some of the exposure.
Well, thanks, both of you. I've really enjoyed talking to you. It sounds really, really interesting. I just need to save up a few extra million just so I can, so I can become one of your customers.
And me both.
Excellent. Thank you so much.
Thanks so much.
Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.